It's Monday, the 17th of February. Welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. It's a pretty busy and data-heavy week. There's a lot of US and EU tension. China's having a bit of a re-rally with the DeepSeek-fueled AI rally. And then there's a lot of macro data that is coming out this week as well. Singapore is set to have a very busy week with the budget coming out tomorrow, as well as reporting some pretty strong GDP numbers for 2024. So that's where we're going to start our show today. We have Brian joining us to take us through what to expect from the Singapore budget, as well as give us some context on Singapore's strong GDP numbers. And then we are going to start charting DBS's path to $50. And I'm going to take you through why I think that's going to happen sooner rather than later. And then the Singapore government has just announced 29,000 old HDB flats are to be upgraded. And Jarek has just initiated an ISOTeam, which is a new Opportunity Plus stock, and we'll explain why. And he's also got an update on SPOST as well. And then Bunyakorn from our Thailand office has downgraded Airports of Thailand. Remember, this is a SDR stock that can be traded on SGX to a sell, and we'll explore why that is. And as always, you have our chart guy with two trading buy ideas as well. But let's start with Brian and bring him on the show. Brian, welcome to the show. Now, let's talk about the budget. That's what everyone's going to be looking forward to tomorrow. This is likely going to be the last budget before the general election. What do you expect from this budget for households as well as for businesses?
Hi, Dylan. Thanks for having me on the show. Yeah, we're looking at a pretty generous budget. So basically, the government has accumulated a 6.7 billion Sing dollar surplus over the current electoral term, past 5 years. We're expecting them to draw down most of this surplus, and that would be to fund a budget deficit of 0.8% of GDP, which is pretty sizable by recent history standards. So basically, for households, we are expecting a generous package. Perhaps it could be called the SG60 package in lieu of Singapore's 60th birthday. Could be form of cash, CDC vouchers, USAVE rebates, so as MediSave top-ups. And we're also expecting that there could be a personal income tax rebate. And the cap could be higher than the $200 that we saw last year. In fact, in SG50 2015, it was a $1,000 cap for households. And I think on top of that, there could be support to defray the cost of essential expenses especially for lower and middle income groups, such as medical care, childcare, and education. For businesses, we are expecting some help to basically defray operating cost pressures. There could be rebates for corporate tax and also perhaps even property tax on commercial and industrial properties, given the stronger than expected fiscal revenue in FY24. There could be some help on manpower costs. Several schemes like the Progressive Wage Credit Scheme, Skills Future Enterprise Credit, and also the Senior Employment Credit, they are either expiring or having their support dialed down this year. We think that the support for these schemes could be extended to provide firms a bit more help in managing wage costs. And on top of that, we are expecting that there could be some flexibility to ease the talent crunch in the sense that, for instance, expanding the eligible nationalities for foreign worker sourcing and also relaxing foreign worker quotas for longer grace period. We're expecting holistic support for households and businesses there.
Got it. I mean, I think high cost has been one of the biggest issues over the last couple of years. So lots of goodies, I guess, ahead of the election to watch out for. Now, Brian, how will this impact your forecast for GDP going into this year? And I ask this given the fact that, we've had very strong close to the fourth quarter GDP numbers of 2024. It actually came in ahead of MTI's own expectations. So can you give us some color there?
So indeed, yeah, the GDP outturn for 2024 was very, very strong. It was at 4.4% full year growth. And basically, some color on details would be that you have the manufacturing as well as the outward-oriented services sectors, wholesale trade as well as finance. These are the outperformers. Manufacturing, I think we saw some benefit or some boost from the front loading of shipments ahead of Trump's tariff threats, new presidential term. Finance, we had some help from the recovery in loan growth. And as for wholesale trade, I think that the construction sector could be lending some support, in fact, because there are mega projects like MBS and also the Changi Airport Terminal 5 that are commencing this year. And we did see some the component of wholesale trade that outperformed was actually the construction materials part. And maybe companies could actually be accumulating supplies and purchasing capital goods. So overall, how does this all feed into our outlook for this year? Basically, we are still looking at GDP growth moderating to 2.6% in 2025. I think ultimately the elephant in the room here is Trump's tariff war. And we think that will slow global trade, and Singapore can't escape given how trade sensitive that our country is. But we expect that the budget will help to cushion the impact from trade. And also, I think in terms in addition to that, the step up in construction activity as well as easing monetary conditions in terms of falling interest rates and also MAS easing policy.
Got it. Thanks, Brian. Thanks for explaining that to us. Now, let's turn to DBS. Stock's done pretty well by every measure last year and closed the fourth quarter with some record numbers. And we've actually upgraded our target price to $51.37, which is actually amongst the highest on the street as well. And we are maintaining our buy call. So we have a lot of conviction behind this. Part of that is coming from the expectations beat from 2024. And if you actually look at it, a lot of that delivery was broad-based. Net interest margins actually held up from hedging, trading, and parking liquidity in low-yield, low-risk instruments. While this may start to come off in 2025, what we also saw was loan growth picking up. We think that this will actually accelerate this year, and management is actually seeing a pretty good pipeline. So net interest income will actually see growth in 2025, despite expectations of rate cuts and so on. On the non-interest income side, wealth management did come off on a sequential basis, on a quarter-on-quarter basis, but this was expected from a seasonality. A lot of people go on holiday in fourth quarter, so they don't do as many transactions. But what's actually more important is that the assets under management still continue to grow strongly. So which means that they actually have a lot more dry powder that can convert into wealth management fees as this year progresses. Now, one of the things that the new incoming CEO talked about and hinted on was what she will be focusing on. And one of the things that she said was she's focusing very much on high ROE businesses. So when you go down that line, wealth management is going to be a key focus, and that's also her background as well. And it should be. ROEs in the wealth management side is around 60%. Plus, their tech investments means that a lot of the clients, as well as their own RMs in that segment, are fairly sticky to their platform. So I think even as you see volatility in the wealth management space, I think DBS has a very strong foothold there. Also, she's looking at transaction banking as well as commercial banking to lift ROEs. At the same time, they're actually integrating a lot of AI across their businesses. This will also be a priority area for the new CEO, and she wants staff to be spending more time with clients rather than doing back office and routine tasks. So one of the things that gives us a lot of confidence is the tech investments that they have been doing over the past few years, which means that implementing things like AI for DBS will be a lot more easier than for some of the peers. So overall, we think DBS's sustainable ROE should actually structurally shift higher in the medium term. We think that'll go up by around 4 percentage points, around 16%. And we think that actually justifies a higher valuation than the 1.3 times price to book that it has traded historically. If you look at North American banks, they generate an ROE similar to what this actually lower than what DBS has, around 12%, and they trade at about 1.3 times. If you actually look at developed Asia Pacific banks, they trade at about 1 times price to book, but only generate about 9% ROE. And if you actually look at their dividend yield that DBS will be paying, given all the special dividends and so on that they have talked about, their dividend yield, DBS's dividend yield is about 230 basis points higher than equivalent Asia Pacific banks. So we think overall, as a bank that generates a very high dividend yield and also generates a very high ROE, it deserves a much higher valuation than where it's trading at. So we are quite comfortable with our 51.37 target price for DBS. You can read a lot more in the newsletter today on my note. Now, with that, let's change gears and bring Jarek onto the show. Now, Jarek initiated on ISOTeam with a buy. This is our latest Opportunity Plus stock. As you know, Opportunity Plus is a label we give our high conviction small and mid cap stocks. So, Jarek, welcome to the show. Now, but before we drill down to your recommendation, can you give us some background on what this company does?
Sure. I mean, basically, ISOTeam is a maintenance player. I mean, they're not really a contractor, but they actually do most of the public housing, rather government jobs, your HDBs and everything. They do the painting, the maintenance, your changing of R&R, A&A works, which includes the signboards and everything, handrails and so on. They also do HIP projects as well. So basically, 70 to 80% of their revenues are from, I would say, the public sector. So I think, that's what differentiates them from other players, is that, they don't really serve a lot of the private sector, but mainly for the HDB sector, which is to us more like a recurring base, because, for HDBs, the older ones will have to repaint every 4 to 5 years and do some maintenance and improvement. And there will always be new BTOs available, upcoming in the next few every year. So basically the pool of HDBs is growing every year, and actually is actually good for ISOTeam as compared to the rest of the other players.
So what's actually giving you this confidence on your buy call?
I mean, the construction sector, has been recovering, and margins has also been recovering because the new projects margins are better than the old projects during COVID. And if you look at construction pipeline in a whole, the T5, basically the new port, as well as other mega infrastructure projects in Singapore, is slated, for Singapore to have a construction boom for the next 2 or 3 years. And if you look at this year also, it's an election year. So normally during election year, I think you can see the article just came out on Channel News Asia yesterday. More HIP projects, start to be rolled out. You will see more upgrading projects, more repainting projects given up by town councils for the public sector, just to have the feel good factor. And I think in the past elections as well, more projects are handed out during the election year. So we do think that, for ISOTeam, it will be a key beneficiary of this trend. And if you look at ISOTeam itself, fundamentally, I mean, they have turned around in 2024, and as of first half of 2025, they have actually net profit actually jumped quite significantly as well. And we do think that, the older contracts with the low margins secured during COVID, where cost shot up, labor shot up, raw material shot up, those low margin projects have now been actually finished. Basically all your any bad debts and everything, most of it has actually been written down already. So basically ISOTeam, is slated to jump quite significantly in profit this year, especially in the second half, because for the second half, they normally do a lot better than the first half due to the project completion recognition schedule. So we do think that, ISOTeam, last year they did probably about 2 million core profit. This year we think they'll do about 7 million. So that's more than a 3 times jump in terms of core profit. And we do think that going forward, their order book will go to more record high levels because of the increase in market share that they have due to one of their competitors, core competitors, actually went bust, which they are private during the COVID-19. So they are likely going to get more market share. And also, if you look at ISOTeam, they have been working on the drone painting solution since 2021. And we think that this is a very interesting angle. Basically, they are starting to implement the solution for testing in the BTO site in April, May. So if they can implement this solution successfully, it will then be carried out more towards more of their other BTO and HDB projects which we do think that is in line with the government's push towards a lower labor for the construction sector, replaced by tech. So if this actually they can cut costs by close to 40 to 50%, with lower labor, as well as you don't have to use the gondola equipment and everything. So the usage of this equipment, which costs a lot of money, will be reduced. So going forward, if this is successful, basically you're looking, for margins to jump up, and also they'll get even more market share because they basically have a much lower cost base than their competitors. And also we do believe that the government will put lower labor use in the criteria for the tenders going forward if this solution is successful.
Got it. So it's actually not just play on the general elections and the increasing volumes. It's also a tech and AI play as well. So that's actually quite an interesting angle. Now let's stay with the small and mid caps and let's talk about SingPost. Now the stock has been in the news lately, and we have to say probably for the wrong reasons as well. First, there was a Parcelgate issue, and now there was a line of resignations from some of the top executives. Yet you are still calling this a buy. Why?
I mean, my thesis for this SingPost is actually not on the business. Basically, we do think that the Singapore postal business is not really very sustainable. It's coming down because of volumes and everything. So now they're right sizing it, and also in talks with the government to increase rates further and to make the business profitable. I mean, my angle has always been the monetization of its assets. Basically, SingPost has, they own a lot of assets, which is worth a lot more than the current price, even after paying down debt. And with the sale of the Australia business, which was the big question mark on how much valuation is worth, I think that has been settled. So now we are just waiting for the EGM to approve the sale, as well as the Australian government approval to approve the sale before the sale is concluded, which will be happening in the next 1 or 2 months, which we expect. So we do think that, with this big hurdle being settled, and the valuation is already there, the rest of it is actually all quite easy to sell, because if you look at SingPost Centre, the valuation is there, and to find a buyer for SingPost Centre, I think that any commercial or retail REIT will actually be quite keen. It just depends on the pricing, and the pricing won't be too far off from their valuation. And then you still have your basically your post offices. All these are all bought at 20, 30 years ago, and their cost is very low, and the property prices have gone up significantly over the last 20, 30 years. So we do think that the SOTP valuation of 80 over cents makes a lot of sense for SingPost, and at the current price is still very undervalued. And if you look at the Parcelgate saga, I think things have died down. Basically, they have replaced the CEO, they replaced with a COO, they replaced with a CFO. And also this morning, they announced two new directors joining in. One is the ex-CFO of SGX, and the other is the ex-CEO of SIA Engineering. All these are prominent people. So, if there's still any problems with SingPost, most likely they will not be accepting this role as a board director, right? So we do think that, things have, we do think that things have cleared down. The saga is over, hopefully. And that going forward, the board has also said that the strategy is unchanged. They will actually start to monetize. They will monetize more assets going forward, and then return value to shareholders. So we do think that a special dividend is upcoming after the Australia sale, and we do think that a significant portion of this proceeds will be given back to shareholders, unless they can justify, like I said, the use of funds for either a new business or to reinvest in the Singapore postal business or the parcel business. But the way we see is that the Singapore business, it's not going to be very profitable. And if you're going to put more money into it, it has to justify, unless, if not, it's going to be very hard to get shareholders' approval. So we do think that's why a special dividend is more likely.
Good. Do you think, is there any time frame that you're expecting for the special dividends or capital returns?
Yeah, according to SGX regulations, I think that dividends for guidelines, SGX guidelines is that dividends can only be declared upon a full release of your results. That means that it cannot be a quarterly update. It has to be like a half yearly or full yearly. So we do think that it will be likely during their full year results in May. So their year end is March, so they report in May. Only then, if the sale is closed by then, should be closed by then, because you need only 1 2 months more. So by May, they would then declare the special dividend to shareholders.
Got it. So that's a key month to watch out for. Jarek, thanks for joining us.
Welcome.
Now let's go to Thailand, where Bunyakon, analyst there, has downgraded Airports of Thailand to a sell and cut its target price by more than 40%. King Power, AOT's main concessionaire for its duty-free business, is facing liquidity issues and has requested an 18-month postponement of its minimum guaranteed payments to AOT. We think the current minimum guarantee will actually not be able to sustain through its concessionary period of which runs till 2033. In the worst case scenario, AOT will need to write off King Power's unpaid debt, terminate the contract, and then call for new bids to run the duty-free for AOT. Plus, the AOT itself is facing some pretty large capex demands as well from developing Bangkok's South Terminal and also new airports in Phuket and Chiang Mai as well. So that's something to watch out for. And if the Thai cabinet approves all these projects, AOT will be free cash flow negative, and that'll actually cause us to revise down our target price by another 20% more. So with all these uncertainties, we've downgraded the stock to a sell. AOT is a Singapore SDR, so you can actually trade this stock directly on the SGX. Now let's have a quick check-in on our chart guys chart. So he's got two trading buy ideas. The first is Grand Venture Technologies. The stock has undergone a correction, but he thinks that the bulls have regained strength, so he's calling this a trading buy. And the next stock is ISOTeam. The stock has hit an all-time high, but he thinks that the RSI is still below overbought level, so the stock has more upside to go. You can see more of his research and clarifications in our newsletter today. Now, just looking at upcoming events and corporate announcements, we've got a whole bunch of results coming through over this week. UOB coming out on Wednesday, Wilma on Thursday, and Cetrium, which has been on a tear recently, is out on the 21st of February. So do watch out for those. We will be covering quite a few of these names in our research. Apart from that, we've got quite a few events coming up as well. The one that I really urge you to join is with Dan Ives, who is a very popular tech and disruptive tech analyst from our US partner, Wedbush. And he'll be talking about what to expect from the US tech sector, particularly in the context of DeepSeek and China's Sputnik moment. So do join us for that by scanning this QR code. That's on the 27th of February. That's all the time we have for today. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.